Almost 90% of the new investors lose their money in their first year. That's not even a crazy part. The sad part is that most of them never end up investing any money in the stock market, and then they regret later in the life. And if you don't want to be in those 90%, you need to watch this video till the end. I'm going to tell you exactly what steps not to take and what steps to take to be a good long-term investor. So we all know that investing is long-term. When we hear the name of investing, we automatically know that it's a long-term game. We can't expect anything in 6 months, in a year, and not even in 5 years. We need to look at the bigger picture, like 15 to 20 years and 30 years. So investing always comes with a long-term commitment with yourself. In 2021, after a couple of years, I started investing. There was a stock called AMC. You can even search it on. So that stock jumped from $15 per share to approximately $450 within few months. And AMC stock was all over TikTok, all over Instagram and YouTube. Many famous influencers were saying that AMC is going to the moon. AMC is going to touch $1,000 or even $2,000 in the future. And I know many people, they end up investing in that AMC stock and they lose money, and now AMC stock is not even $3. So we need to stay out of meme stock. And that's the first point. Never chase quick profits. In investing, there is nothing like quick profits. Yes, there are times when we can make good profits, like back in April 2025 when the stock market was down. There was a time when if we invest $1,000 in NVIDIA, we today have $2,500. But when the dips come, we don't know how long the dip's gonna be because there is a fear in the market. So the best idea is to don't worry about quick profits. Always do consistent investment, and when you see the market is down, invest more. The second point is panic selling. So now the information is everywhere on TikTok, on Instagram, on YouTube. There are many influencers. So when the market dips, there are so many influencers, they say sell your investment, otherwise you will end up with nothing. There's an abundance of information, so we need to figure out what's best for our interest. And especially when you're a new investor, when you see there's a positive return in your portfolio and suddenly you see a red sign and you keep on seeing that red sign for a couple of months, then you think that what if all my investment, all the gains I have made in few months or few years, what if they all end up in a loss? So what if I now sell it, I end up with some or few money? So in investing, panic selling is pretty common. And it's not about what we think about the company, it's about what we hear from other people. So don't let your emotions cost you money. Always do your own research, always look at the fundamentals and the long-term stability of the company. So back in 2022, Meta and Microsoft, I invested a lot of money in those stocks. And when the stock market fall, Meta was dropped to $70 and my average price was $300. So I was in pretty big loss. And also in a Microsoft, I was in loss. But I knew that these two companies will gonna thrive in the future because of artificial intelligence. And I kept on buying more stocks instead of panic selling. And now I have huge returns on those stocks. And the third point is related to the first point, no patience. So compounding, as I told before, takes time, at least 5 to 20 years. So you need to have consistent investment, at least till $100,000. Because after $100,000, you're gonna see the real effect of compounding. Some people, they invest $20,000 and they don't see compounding happening, and that's when they quit. So you need to have patience, at least till $100,000. And once you reach $100,000, you're gonna see the compounding is doing its work and you're doing less. And as you go towards $500,000, $1 million, you're gonna see that you're putting less money, but you're getting more returns. And that's why patience is really important if you're an investor in the stock market. And the fourth point is taking it as a gambling. So day traders, they lose a lot of money. Almost 99% of the traders lose money and 1% of the traders make money. And I'm not saying don't do day trading, because people had made some good money in day trading and it's addictive too. But you need to have real plan when you're doing day trading. I'll say if you have to do trading, do swing trading. Let's say if you know that NVIDIA stock is gonna jump in a year or so, you're gonna buy some contracts of NVIDIA. So instead of less returns, you're gonna have more returns as you're doing swing trading. And the fifth point is quitting too early. So let's say if you want to invest in S&P 500, that gives 8 to 10% return every year. So if you start at 21 years old, invest $500 every month, you're gonna have more than $2 million after 20 years. So that's how compounding works, and that's why it's a long-term game. And if you see $500 a month, if you break it down to a week, that's about $125 a week. And that's not much. And personally, $125 a week is like you're not gonna know that it's leaving your bank account, but after 5 to 10 years, you're gonna see, or even after a year, you're gonna see that those $125 made a huge gain in your portfolio. So what I did back 4 years ago is that I put auto investment. So my Wealthsimple tax-free savings account is connected to my TD Bank. And every week, $125 get deducted and invest automatically into tax-free savings account. And it's not only getting deposited into my tax-free savings account, I put it to the places. So $50 from them goes to S&P 500 ETF, $25 go to QQQ, $25 goes to SCHD and few other stocks. So I give the meaning to that money. And honestly, when you put auto deposit, you will get used to it. You're gonna get used to working more so you can keep up with investing. And data shows that 80% of the Americans who set up auto deposit never ending up breaking the cycle. So once you set up auto deposit, you will do your best to keep doing it instead of quitting it. And many people, what they're doing wrong is that they say, when I get money, I'll see if I have any extra money left to invest. And that's where many people get it wrong. And what generally people do is that, let's say they got $1,500 pay, they spend $1,000 and then they see, oh, I end up with nothing, and then they never end up investing. It needs to be other way around. Invest first and then spend whatever is left and save for emergency fund. And almost 90% of the people are doing it wrong. So you need to be wise with your financial decision. Invest when you get paid, or the best thing is put auto deposit on. So you will not even know the money is leaving your bank account. But when you see your investment account, and personally what works for me is that stick to the ETFs. So the 3 ETFs as a beginner, I want you to stick to. First is S&P 500, second is QQQ, and the third is SCHD. Stick to those 3 ETFs. You don't need any extra ETFs because some people think that the more ETFs, the better it is, but it's not, because many ETFs and index funds end up overlapping each other. So you need to stick to the ETFs that's giving you broad market exposure and have different advantages. And all those 3 ETFs have their own different advantages. So you need to stick to those ETFs, and over time you'll see that you are getting good returns. And in the end, I want to say that investing is very simple. You don't need to stress yourself. You don't need to find another Nvidia. You don't need to continue exploring the charts. You just need to put consistent effort, because consistency beats talent. If you find any value from this video, like this video and subscribe to my YouTube channel for future videos.